Stock Analysis 17. We are back. Today we're talking income potential of business development companies, or BDCs. Thank you to Calvin Emerson for the suggestion. Main Street Capital Corporation, stock ticker MAIN, provides debt capital solutions and makes private equity investments in privately held businesses in order to generate monthly income for their shareholders at a rate of 6.04% annually. MAIN is trading at a share price of $41.37 with a market cap of $2.838 billion. They currently have a 52-week range of 26.68 to 43.56 and are subject to slightly larger than average price movements with a beta of 1.51. Main Street Capital has been successful recently in beating out their earnings estimates and currently host an earnings per share of $4.60, resulting in a PE ratio of 9, and this is right around that desired value. Before we look at that mouthwatering monthly dividend, we got to understand how BDCs function and the value they provide. Business development companies primarily concern themselves with investing in either distressed companies or ones that have yet to grow properly or efficiently in their initial stages. To qualify as a BDC, a company must invest a minimum of 70% of their assets in U.S. firms with market values below $250 million US. Once a company achieves BDC status, they are required to distribute at least 90% of their profits to shareholders annually, and said payments are taxed at the investor's ordinary income rate. None of the important stuff. Business development companies make great income investments because they offer high dividend yields. Nothing good comes for free though, and BDCs are no different, as they are generally riskier investments due to the large amounts of leveraged debt necessary for their business model. Additionally, companies structured in this way are sensitive to increasing interest rates, and to make matters worse, as they are generally investing into businesses, their holdings lack liquidity. We will look into both of these issues more in depth later, but let's first look at that dividend so you can decide for yourself if it's worth the risk. Main Street Capital currently has a dividend yield of 6.04%, giving you an annual payout of $2.52, which is paid monthly. They do, however, have a payout ratio of just over 103%, which expresses the percentage of their earnings being paid out to shareholders each year. Because Main is a BDC, a high payout ratio should not necessarily discourage you from investing, but we still want to see it under 100%. Also, with a 5-year average dividend growth rate of 2.64%, it appears that Main may not be too concerned with growing this dividend. And as business development companies are riskier investments, you should not expect consistent dividend payment amounts like you would a blue chip company, but things are not all bad. Take note of Main's supplemental or extra dividend payments, which signify dividend strength to shareholders. This bar graph here better exemplifies the dividend growth, as it is expressed by the quarterly payout amounts rather than those monthly totals. Not only has Main been able to grow their dividend 91% since their IPO, but they have also never needed to decrease their monthly dividend. Even more impressively, and another great sign to investors, is that Main was able to continue dividend stability and growth through periods in which their net asset value, or NAV, was decreasing. Main Street Capital has a price to book ratio of 1.78, which conveys the share price is trading slightly higher than the book value of the company. Additionally, they currently hold $58.8 million in cash, which is shadowed by $1.42 billion in debt. This doesn't look great, but the current ratio of 2 is a redeeming factor, as Main's short-term assets double their debt obligations for up to a year. We've touched on the risks of BDCs slightly, and these risks are currently magnified by the Fed's need to increase interest, especially concerning those debt levels. It seems Main has it under control though, as they have already planned for sharp changes in interest rates, with 88% of their outstanding debt obligations having fixed rates. This can be seen through their long-term leverage, which has maturity timeframes up to 2026, but the highest fixed interest rate is only 5.2%. Possibly the strongest fundamental metric which shows Main has control of their balance sheet is the debt to NAV ratio. Since at least Q2 of 2020, Main has held more in assets free of obligation than they've had in financial leverage. Main Street Capital reported profit margins of 126%, with operating margins of 84% and a return on assets and equity at 4.56 and 20.83% respectively. One reason for this may be Main's operating expense to asset ratio of 1.4%, which drastically outperforms their peers. Additionally, it outperformed their own target ratio of 2%, which shows the success of the incentivized internal corporate structure which Main Street Capital has implemented. implemented. The internal structure consists of two small business investment company funds, or SBICs. These funds allow Maine access to favorable, low-cost government-backed leverage. This allows not only for greater shareholder returns, but also has significant impact on the net investment income of Maine, which was growing at favorable rates up until 2019. With that being said, however, Maine is projecting their year-over-year investment income to be back on track with an ambitious 20% estimate for 2021. Main Street Capital's total investment portfolio consists of 177 lower middle market, private loan, and middle market portfolio companies weighted at 45%, 29%, and 15% of the portfolio respectively. The biggest takeaway here is the superb diversification, wherein the largest individual company is weighted at just 3.2% of the total portfolio, with most investments being less than 1%. This diversification continues by industry, with the largest investments in construction and engineering at 7%, and healthcare services, aerospace and defense, professional services, and leisure products at 5%. Furthermore, Maine has reach in the entire country, being diversified fairly evenly in each region. The largest focus of Main Street Capital's investment portfolio are those LMM companies, as they offer ideal dividend income, as well as the opportunity for periodic capital gains while having low correlation to the broader debt equity markets. Another reason the lower middle market is a favorable target for Maine is because there are just under 200,000 domestic companies reported by the 2017 census. Maine has been able to capitalize on this, investing into 69 LMM companies with a value of $1.341 billion, and the equity supplied to 99% of them has resulted in a 39% average ownership for the BDC. The diversification for this portion of the portfolio is slightly less impressive, but that's alright because there's a smaller sample size and we've seen the bigger picture. But the construction and engineering, professional services, and software industries contain the largest percentage of the LMM holdings, which are focused slightly more on the southern states and west coast. The second largest portion of Maine's total portfolio, private loan investments, account for 29% and focus on generating cash yields to support the monthly dividend by targeting gross yields between 8 and 12%. This is achievable due to low overhead requirements, as these investments target privately held companies which have strategic relationships with Maine and other investment funds. These 69 investments account for $863 million in portfolio value, and each individual investment accounts for less than 1% of the entire portfolio average. The last large portion of Maine's portfolio, middle market companies, which account for 15% of the total weighting, target gross yields between 6 and 10%. These investments are important to make because these companies are generally a bit better off than their LMM sisters, providing more relative liquidity to Maine. Additionally, these 39 investments represent $434 million in portfolio value and are held as potential sources of liquidity for future investment opportunities. We've covered almost the entirety of Main Street Capital's investment portfolio, but in May of 2012, they ventured into an investment advisor role to the MSC Income Fund, a non-listed BDC. This relationship was cemented in October of 2020, and Maine was able to successfully create another diversified stream of income. As of June 30th, 2021, Maine has been able to grow this side of their business, reporting $92.2 million in unrealized appreciation. Alright, I just unloaded a ton of information on you, but does it actually mean anything? Is Maine a successful BDC and a good investment? Since their IPO in 2007, Main Street Capital Corp has been able to offer investors total returns of 775.85%, beating out both the S&P 500 and Russell 2000 over the same time frame. Additionally, they blew their peers out of the water, giving Maine investors better returns at a rate of 184%. Jumping to the one-year chart, we see the share price in an upward trend illustrated by the gray 200-day moving average line, but the 20-day moving average has shown the share price to have recently leveled out after a correction on that May 12th dip. Of the three analyst price targets, the average price share value is $43, while the current share price of $41.37 is sitting halfway to the low benchmark of $40. Yes, dividend stocks do outperform growth stocks in bear markets, but I do not like the risks you are taking with Maine or really any other BDC, given the current state of the economy and inevitably increasing interest rates. This is coupled with the fact that Main Street Capital Corp is already trading just under their 52-week high, so unless you are planning a long-term position, Main should not see any drastic price appreciation in the near future. If you're only choosing Main for that monthly dividend of 6.04%, you should first investigate some other options. You can start with my last stock analysis on the QYLD covered call ETF, which currently pays a monthly dividend right around 10%. If you enjoyed the video, I encourage you to subscribe to the channel and like the video. Leave me a comment down below. I'd be interested to know if there are any other BDCs which you think may outperform Main. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.